Well, good morning. We will call the February 12th, 2024 Oklahoma City Post-Employment Benefits Trust meeting to order. And item number 2 on our agenda is approval of the minutes. That item passes unanimously. Item 3A is our first one for items for individual consideration. We have Doug Anderson here that will provide us the quarterly investment report for the period ending December 31st. Doug?
Good morning, Mr. Chairman and trustees. Are you going to be, okay. Let me just see here. All right. We are talking about returns as of the end of the year last year. And as we remember back through last year, it was kind of an unsettling time through most of it, but luckily we did end up on a very strong note. Before I move too much further, this is our annual CEO's letter from Mike Welker. And there's a lot of normal things about how excited we are at our firm, about new partners named to the firm, but I call your attention on the right-hand column, the first full paragraph there. And our company is undergoing a very exciting change right now. We are joining Mariner, which is a very large wealth management firm based in Overland Park, Kansas. They have about $120 billion in assets under advisement. They have about 1,600 employees, but what they do is very similar to what we do, except for they do it for individuals. We'll be joining their firm as an entire organization, and we're going to be forming a new vertical for them. We're going to be known as Mariner Institutional. So all of our people are moving over. To put a really deep in the weeds point on it, we are taking our own corporate structure over, our own registered investment advisor. So our ADV will not change, and that's, if you really want to dig deep on who we are and what we do, that's the document that does it. It's legally filed with the SEC. So we are joining as their new institutional arm. They're also going to be changing their name from Mariner Wealth Management to just Mariner. And so not next quarter, I don't think, but the quarter after that, our logo will change and we will be Mariner Institutional. One of the things we like about them is that they are very much client-first oriented like we are. They're independent. They are paid by their clients only, just like we are. So it keeps us independent, keeps us objective, and it keeps us focusing on you as our clients. One of the things that we learned about them very early on is that their motto is clients first, associates second, shareholders last. And that's very similar to how we are right now. So it's a good fit. There will be the changes in the letterhead coming up soon, but hopefully you guys won't see anything else, and that's the worst that could happen. We're getting a lot of resources because they are a very large firm. Their owners are very resourced, I'll say that, and we are their largest acquisition. One of the things that's happening concurrently to this, it closes on April the 2nd, we are also buying another consulting firm. We've been acquiring firms more or less on a regular basis, but we're acquiring a firm in Kentucky that focuses on endowments and foundations. That transaction is closing at the same time as the other one, so you can imagine how complicated a lot of this will be. So same people, same organization, different title, different ownership structure moving forward. But as on the wall at Mariner's headquarters, just like at ours, it says clients first. And I think that's important when we were making the decision to join up with another organization. So any questions about that before I move on? Thank you. Organization, you can see 89 employees. Again, we have $100 billion in assets under advisement, 89 employees. Mariner has $100 billion or $120 billion, 1,600 employees. So we're a nice fit into their overall organization. Okay, we're going to go into performance here. When I look at the fourth quarter of last year, we ended the year very, very strongly. Equities up, domestically and internationally up quite a bit. Emerging markets, you'll notice, is a little bit lower than the other indexes there. That's the MSCI EM, 7.9 for the quarter versus 9.8 for the for the all country and 10.4 for EFA, which is developed markets. China. China is lagging the rest of the world. In fact, so far this year, China's market is down dramatically. And again, that's part and parcel of that index because they make up more than 1/3 of that individual emerging markets index. Looking at fixed income finally came around in the fourth quarter of last year. We were well on the way to our third calendar year in a row of negative performance from bonds, which is incredibly unusual. But the fourth quarter, what happened was what people are calling the pivot party. The people who make up the names of these events, they're not very creative. But during the fourth quarter, the Federal Reserve pivoted from inflation is terrible. We're fighting it hand over fist by raising interest rates from 0 to 5 1/3% over 18 months. In the fourth quarter of last year, it became apparent that inflation was going down dramatically. So at its peak, it was above 15% per year. As of most current readings that I see right now, it's about 1.5% per year. So that's below the 2% margin of inflation that the Federal Reserve is comfortable with. The odds that the Federal Reserve cuts rates this year are rising, but the number of cuts appears to be declining right now. It was more or less a foregone conclusion for a few minutes, at least, that the Fed would cut during March. That's off the table right now. Looking at the one-year performance, it was a great year to be invested in equities. Thankfully, we have a lot of equities at this fund. It was a better year to be invested in large equities than small equities, and a better year to be invested in small equities in the U.S. than non-U.S. equities overseas. And again, emerging markets really holding back the ACWI index. And developed markets doing very, very well at 18.2%. And looking at bonds, bonds were up for the year, which looked highly unlikely going into the third quarter. And then the 3-month T-bill, again, our risk-free asset, 5.2%. That changes a lot of things looking forward if we can invest money productively with no risk at 5.2%. I'm not going to talk much more about them unless you would like me to. Point out a couple of things about the U.S. equity market on this slide. The two largest companies on the upper left-hand for the Russell 1000, two largest companies, 6.5%, 6.4%, Apple and Microsoft. That is the top two of the Magnificent Seven that's driving the markets right now, and there are a lot of reasons why people are rationalizing why they should be able to grow forever and dominate the markets. But you look down that list, and it's Apple, Microsoft, Amazon, NVIDIA, AI chips, Alphabet, Meta, Alphabet, and Tesla. So those are the Magnificent Seven. You have two names one name that is repeated, and that's Alphabet because they have different share classes. But those are the ones that are really driving things. And remember, 2 years ago, those 7 companies were leading the way. Last year, when I say last year, I mean 2022, energy, these companies fell apart for a little bit, and then this past year, you can see how strong the returns are. 49, 58, 80%. NVIDIA, of course, came out of nowhere to be 239% return because of the AI chips that they produce. But those returns are phenomenal. Meta used to be the old Facebook, up 194%. I mean, 2022, that company really fell off a cliff, but it has come back. I think that's a nice slide to go to right here. Last year was a great year for the fund, 19.3%. Did we do anything differently? No. We executed the strategy that we built several years ago, and the biggest change we made several years ago was to include more equity. Our long-term investment horizon here allows us to do that. We have built in the compounded returns over the last 10 years, and having that behind us, we can go ahead and assume more equity risk going forward because the life expectancy of this fund is effectively, to us, it's almost infinite. So we can invest that way. I'm going to go through here. You can see that we are above the high point that we reached in 2021. You can see that there was a sell-off in between then and now. But if we look at the beginning market value, $6 million, it's on this lower left side here. Contributions over this time have been $151 million, distributions 105. So we've paid out $105 million in benefits from here. Gain of $49.8 million, ending market value of 102. You can see that we even have double And over this period of time, our income, so that's interest income and dividend income, is twice as much as the initial funding amount. So this is a mature portfolio, and this is what we really like to see. Asset allocation has been pretty stable, although equity has been on the increase over time. If you look at the very early years, so this is 2009, we started out with a higher than average allocation to fixed income because it was low risk, and we were not aware of when the financial market crisis, the great financial crisis, would have ended. So we were cautious at the very beginning there. And our asset allocation. We have a decent amount of equity, 65.4%, core fixed income at 15%, international equity at 11.8%. And then we have the two other fixed income portfolios, active duration, which is treasuries, and then high yield at 2.1%. And these are the investment managers that we have. Fidelity is the largest with their S&P 500 index fund. It's the lowest cost version out there. Causeway, international equity. And then you can see Stevens and Hotchkiss are two other equity managers, active managers. Loomis Sayles and DoubleLine are core fixed income. They have a roughly equal weight. And then we have a mid-cap index. If we recall, we were having a real hard time getting consistent returns out of our mid-cap active managers, so that's why we have this piece right here, although our mid-cap equity manager has done very well. And then you can see our other portfolios. This is for the 1 quarter. Yeah, this is for the quarter. You can see it was a great quarter. We started the quarter with $92 million. Income was just under $890,000, but appreciation was almost $9 million during the quarter. That was a fantastic recovery. And here is what it looks like in return calculations. For the quarter, the total fund net of fees was up 10.62%. That little one that you see in parentheses next to it is the percentile rank versus the public funds peer universe. It occurs to me that the universe that you're ranked in is public funds from 50 to 99.9 million. We are aged out of that, I guess you would say. We're now above 100 million. I don't expect it to change where you rank significantly, but we will need to change that going forward. You look at your policy index was 10.11%. So your policy index outperformed effectively 96% of funds in your cohort. That's because we have more equities. Your actuarial assumption of 1.82%, you buried that during the quarter. In fact, looking at the year to date, which is the same as the 1-year rate of return, your total fund was 19.26%, ranked in the 2nd percentile, and performed extremely well. Now, why is it the case this year? Our bonds were okay in aggregate, even though we had some noticeable underperformer from one of the funds. But during the 4th quarter, they did very, very well. Loomis Sayles up 7.37, DoubleLine up 6.5, Lord Abbett up 6.88%. And then the one that had been performing very, very poorly, Hoisington, was up 13.99%. This is the result of the pivot party. Interest rates went down dramatically as inflation sort of moved from first to maybe second or third worry in the Federal Reserve. And looking down the 1-year rate of return for those managers also, they did very well, with the exception of Hoisington, which owns 30-year treasuries, which was not good for most of the year, but phenomenal during the 4th quarter. Now, looking at our equity portfolios here, the total domestic equity portfolio for the year was up 23.13%. Now, Fidelity, the index fund, carried the water of the rest of the portfolio. Remember, this is the one that has the higher weighting in the larger cap technology stocks, and that's what drove the market during the year. Our Vanguard mid-cap index fund, it did exactly what we wanted it to do, or what it's intended to do, which is match its benchmark index. And you can see Hotchkiss and Wiley, the mid-cap value, it was up 20% for the year, which is 10th percentile amongst funds like that. For the 3-year period, it was up 19.42%, 1st percentile ranking, and outperformed its benchmark index by 11% per year over those 3 years. These are annualized rates of return. So This has been a phenomenal performance, and we have to go back a few years, but the performance was almost the exact opposite. We had really worried about them for a while, but their performance has come around, to say the least. And you'll see our small cap growth portfolio, 19.46% for the year, which is phenomenal. And then you can see we had another great performer for our international equity portfolio. Causeway was at 27%, third percentile. Its index was up 18. Those are remarkable margins of outperformance in several of your portfolios for the last year. So that is that. I'm going to go to sort of our more fiduciary items here. I mean, performance last year, I wish I could say we're going to do it again and again, but last year we hit on all cylinders once we got to the fourth quarter. On page 44 is our watch list. No changes to this. I think Hoisington should stay on there until the 1-year number gets up a little bit higher, but we understand their process and why they performed the way they did. Here is a very important slide on page 45. This is the expense ratios of your funds versus the category averages. You can see that you are 43 basis points on a weighted average, asset-weighted basis. Your category average would be 91. So we're saving better than half on the fees. And we're obviously not giving up any performance for that. And our annual savings is about 400 versus the median there, the category average, $440,000 almost. That's fantastic. And then these are our compliance checklist, mostly yeses here. You can see there's one, the 3-year return outperformed the policy index. Your policy index is very high bar, and it underperformed by a small margin. But we have mostly yeses on here. And then mostly yeses on this slide. Hoisington is the one that's kind of the iffiest on some of these, although Lord Abbott on the high yield, that's a tough benchmark to beat also. So I'm very pleased to bring this report to you today. Performance is phenomenal. It doesn't often happen, but a fellow named Jeff Perniske that I've worked with for decades is the performance analyst on this, and he sent this to me, and he was like, this is fantastic. And I was like, absolutely it is. This is one of the best returns that I have. It is the best of my clients for this quarter, but it wasn't a quarter or a year that we did this. This plan's been in place for a long time. One thing that I want to make sure we are doing is maintaining our target asset allocation. And this one is a slide that says our domestic equity has performed so well, we're outside of policy. So adding to or taking money away from this portfolio, we're going to be taking it from domestic equity. And as painful as it may look, we are underweight on active duration fixed. So money should be going there to rebalance us to our long-term targets.
So it looks to me like you'll do some harvesting.
Yes. I read some interesting research about this, and it's practical asset allocation and rebalancing. And it was done by Vanguard Institute, and they do a lot of work for institutional investors. And they tried to simulate, they use a lot of brute force simulation, statistical simulation to try to figure out what the best time to rebalance is, the best time frame. And it seems awfully convenient, but it's about once a year, right? If you need to rebalance, it's about once a year. But in my experience, funds that have frequent cash flows, coming in and going out, they said in the absence of frequent external cash flows, the best time frame is about a year to do that because you harvest. And that's what we want to do here when it's time. So that is the 1231 report. Again, fantastic results. Let's be realistic going forward. It's not always going to be that way, but we have good exposures to a variety of investments in this portfolio.
All right, any questions for Doug? Having none, I would entertain a motion to receive the quarterly investment report. Would you vote? vote. Passes unanimously. All right, now we go to item 3B, which will receive the monthly investment reports for November, December, and January. Doug?
Thank you. This one will look a little bit strange after what I just showed you. So January ended the month sort of uneven, but the S&P 500 did really well versus other investments out there. And looking at this, you can see the market value of $101 million, almost 102. And then performance, total fund was down slightly for the month, down 43 basis points. Still positive for the quarter, trailing 1 year at 10.79. But looking down the list, for the month, you can see that we had one negative on fixed income, and that's Hoisington. The quarter is still almost double what the other ones have done. When we look at equities, you can see the only equity portfolio that we had was positive was the S&P 500 index. So that's the largest that did drive it. So the month was a little iffy. I look at as of Friday, it's a little bit better, but again, it's early, very early on in the year. Earnings have been positive as far as corporate America, but it's pretty early, very early on in the year. Presidential years are generally good. Presidential election years are generally good for the marketplace, and years following strong equity markets also tend to be pretty good. So just historical perspective, that's not a forecast by any means, but in previous situations that we have seen like this, it's a good time. We're not investing for this quarter, or even this 6 months, maybe this year, 3, 5, 10, that's what we're looking at.
After the way that we ended 2023, I'd rather just accept the first 2 reports and not the January one. Get away with it. But I know that's not how we can do it. I know. I'm just.
That would be a bad precedent, I think.
That would be nice.
I'm sorry, we're going to need another $1 million.
Any questions?
Doug, I don't know, did you send everyone else the information that you sent to me?
I did not. I sent it to staff, but you asked the question about the number of equity holdings.
Number of equity holdings, and I followed it up with, I'd like to know the officers and directors, their percentage shares of equity held in each company, and whether or not they're in compliance with Section 16 of the Exchange Act.
That's going to take a little while to develop. Now, I will say, me being able to determine compliance with Section 16, it's like proving a negative. If any of them have gotten in trouble for that, I will tell you, but that's not common in this day and age. In this day and age, reporting by corporate directors and officers is not an option, but I'll follow up with that in due time. It's going to take a little while.
Yeah, because I don't think it was ever an option, but some have gotten away with it, and so I just think that if we look periodically, just to make sure.
Yeah, I did see somewhere recently that there was, I can't remember the fellow's name, but it was a billionaire. I can't remember if he was American or English, convicted of insider trading, and we really haven't seen that for a while. We definitely have not seen insider trading amongst corporate directors and officers. That went by the wayside a long time ago. The SEC's, what do they call it, surveillance is pretty strong. Understood.
All right, with that, I'll entertain the motion for item 3B. A motion and a second, record your votes. And it passes unanimously. Thank you, Doug.
Thank you.
Now we're to item 3C is acceptance of the annual financial report for fiscal year ending June 30, 2023. And David Perez from accounting is here to present.
Good morning, Mr. Chairman and trustees. So I have a few points to make over the June 30th financial report. If we look at page 1, of the financial statements. We're going to look at the opinion letter. And the trust was issued a modified opinion again this year, the best outcome we can receive. And the opinion letter can be found in its entirety from page 1 to page 3. And next, let's look at the statement of planned net position, which is on page 9. A net position of $94.94 million was reported for June 30th, 2023, increasing by $9.08 million over the prior year net position of $85.86 million. This increase was primarily attributed to an increase of $8.2 million in the fair value of investments over the period. Next, we're going to look at the funded ratio, which is on page 35 of the actuarial report. And the funded ratio looks at how much actuarial liability the trust has compared to the plan's net position or the funds the trust has to pay the liability. At June 30th, 2023, COP had a funded ratio of 59.5%, which is an increase of 7.5% compared to 52% in fiscal year 22. At June 30th, 2023, the city had a funded ratio of 26.3%, an increase of 4.2% compared to 22.1% in fiscal year 22. And then lastly, we look at page 37 through page 40. This is a historical graph, and it's going to show us that COTPA and the city have had a steady increase in their funded ratio since 2017, where the funded ratio started for COTPA at 19.8%, and the city's was at 8.5%. This concludes my presentation for OPEB's fiscal year 2023 financial report. If you have any questions, I'd be happy to answer.
I just think it was, when I look at it, thank you, David, I was just thinking when you look on page 37 and you look at what our liability, how it has declined over $100 million over the last 5 years from 2018, 2019 was $478 million, now it's down to $383, and that's because of the policy adjustments that City Council made, and then the fact that we're earning, Doug's doing a good job with the money, it's a good story to see that we're at 26.3%. So we doubled in 5 years our funded ratio. And that's something I'll be telling the rating agencies later this month. So, thank you. Yes, thank you, David.
And you're so right about how important that story is. You hear about cities all over the country that are being downgraded or having financial issues. And of course, it's not just OPEB, it's their retirement liability too. But we really have a good story overall to tell that we've been very proactive in taking care of that over, it's taken a long time. We didn't start yesterday, and we knew when we went into this that it wasn't a change that we would make immediately, but I think it's really been a good story to tell.
All right. So I need a motion, I believe, to receive this report. Passes unanimously. All right, now we're off to item 3D, which is a joint resolution with the Oklahoma City Municipal Facilities Authority, renewing a master service agreement with Premise Health Employer Solutions to provide medical center program for eligible employees and retirees. Its estimated cost of about $1.9 million. And Jason Long is here to answer any questions that you may have.
Good morning, Chairman and trustees. Okay. Any questions? Utilization. We are getting close to about 100% utilization. I know that since Premise has come on board that we've had a tremendous response and number of patients being seen, both active as well as retirees. Dr. Ugu has come on board early part of last year, and it's been very successful. I can speak from personal experience that the care that she is providing at the clinic has been excellent. We've been getting tremendous feedback from our actives and retirees as well.
All right, I'll entertain a motion for item 3D. Passes unanimously. Item 3E is a joint resolution with the city and the MFA approving the administrative services only agreement with the Blue Cross Blue Shield.
All right,
Ed?
and, oh,
Go ahead.
I'm sorry, I apologize. So we went out for bid early part of 2023, not only for our group indemnity PPO plan, as well as our HMO plan. At that point in time, we also provided an option to look at an EPO plan, which is an exclusive provider organization option. And so as part of that RFP process, the selection committee recommended that we stay with Blue Cross and Blue Shield for our PPO option, but we migrate over to Blue Cross and Blue Shield for our EPO option. The selection committee found that the Blue Cross Blue Shield offered a broader network, nationwide options, as well as better network pricing and administrative fees overall for the EPO plan. So once that selection committee made that determination, then we had to reach out to the various stakeholders, which are our collective bargaining units, and get agreement with those. We got that in the early fall of last year, and then at that point we could proceed with negotiation along with, and you'll see an item later on for stop loss. And so we had to go out for a separate RFP now that we had EPO and needed to have stop loss for that line of business as well. So any questions?
Jason, no question. Just thank you for you and your staff for shepherding the project through. And it was a lot involved and be able to make it happen. But really appreciate the forethought to be able to get a good partner and to be able to get this implemented.
Thank you very much. And one other thing I would like to add real quickly is that we've, now that we're into February, we have seen a very smooth transition over to the EPO plan. We have not had a lot of calls into our office with questions or concerns regarding the new coverage. So everybody seems to have transitioned over, and judging from the weekly claims, we are processing a lot of prescriptions as well as a lot of medical claims on our new EPO plan. We are just kind of FYI for the month of January, we're about 2.5 million under projection. Some of that's going to be claim run out, but we are starting afoot on a strong note on that.
All right, I'll entertain a motion on item 3E. Passes unanimously. Now to item 3F. Again, this is between the city and the Oklahoma City Municipal Facilities Fund with Dearborn Life Insurance Company, doing business as Blue Cross Blue Shield. This is for eligible retirees.
And this was another product that we went out for RFP last year, and this is for our group life products. And so on the active side, we have our basic life that's provided by the city. It's a $20,000 policy along with AD&D benefits, and then we have voluntary life, spouse life, and child life tied to that program. For our retirees, we offer a $10,000 retiree life policy. Some of the highlights as far as concerned for our retirees is that we have a rate guarantee for 5 years, which is very significant. No change in total premium for 2024, and no change in plan design or benefit. And so the cost, estimated cost is $360,000, and the retiree pays 100% of those premiums.
All right, I'll entertain a motion on item 3F. Passes unanimously. Item 3G, again, is related to Blue Cross Blue Shield, similar, and for stop loss insurance.
And so for our stop loss, as soon as we made the determination that we were going to go with the EPO plan, we went out to bid for the stop loss. We did have only 2 respondents, our incumbent Blue Cross and Blue Shield and another company that was going to be about 150% increase over our current rate. So Blue Cross was the chosen provider for the benefit. Just a couple of highlights is that we're doing a 1-year agreement with 4 optional renewal periods. The stop loss, we did also add an aggregate stop loss benefit, and the simple reason for that is to help protect our plan now that we are going to the EPO and we're taking on the HMO population, just to make sure that in the event that we are the 0.1% of clients that had a really bad year, that we do have some sort of buffer protection. Aggregate stop loss is relatively inexpensive, and it was only going to cost the city about $40,000 annually to protect us at over a certain threshold, which was about $120 million.
Jason, I do have a question.
Okay.
Now that Blue Cross Blue Shield is the EPO provider and the PPO provider, is there still coordination of benefits? There used to be with the HMO plan and the Blue Cross plan.
My understanding was with the United Healthcare being an HMO plan that there was never a coordination of benefit, but now being self-funded with Blue Cross and Blue Shield, there should be coordination of benefits with both the PPO and the EPO plan.
Well, there was
Okay.
with the HMO plan before as well, so
Okay.
I know a lot of retirees would want to know that.
Okay.
So thank you for that.
Okay.
Also, what is the aggregate now under the stop-loss policy? I think it used to be 300,000. Is it still the?
It is still 300,000. We did not at this point make that change. That's one of the things that we will evaluate in future years. There was some discussion maybe to look at the aggregate, but with all the changes with the EPO, we wanted to hold off to get a little bit more history with the EPO plan before we raise that aggregate.
And do you know how many have hit that amount, the percentage?
For 2023, we had 7 total.
Okay. Thank you.
You're welcome.
All right, any other questions? All right, then I'll entertain a motion for item 3G. All right, motion passes. Thank you, Jason. Item 3H is to ratify the claims for November 1st through January 23rd. And that also passes unanimously. Now, item 4 is our comments from trustees, staff, interested parties. Anybody here have a comment?
No, I already made my comment.
You made your comment? Okay.
Me too.
All right. With that, we move to item 5. We are adjourned at 10:38.